right, and let's do a screen share. Okay, and there we go. Okay, usually I just go in and start talking, but I have to say this is I've been saying for a long time that this is the most dangerous and opportunistic market that I've seen in about 40 years of doing this. And I would also add to it, dare I say, exciting. Uh, Probably a better word is enthusiastic, and I mean on my part. I just see so much out there. I see so many ways to do the only two things that I care about: avoid big loss, ABL, and then make as much as I freaking can, keeping in mind that avoiding big loss is more important because you can always make money with anything at any time. But if you take too much risk, you're out of it. And that doesn't matter if you're a swing trader or a long-term investor. It pretty much works the same way. So what I'm going to do here, after I add in a missing digit to the date, is I'm going to walk you through fairly briefly the threes report and talk a little bit more about what I just alluded to, the state of markets and investing as it is. I'm going to talk to you a little bit, kind of using the threes report, a bit of the technical picture. And I like to take some scratch notes here. So I'm going to take a few. I already have it on here, but it's worth putting in here twice. Okay. Uh, this market, it may be complex in some ways, but when it comes down to how to make your life simpler as an investor, which I am always bullish on, it's making it simple. And simple does not mean that there's no brain work. There's actually a lot. You can't get to simple until you've done a lot of complex work. I like to think I've done a lot of the work, and that hopefully that's why this group works so well. But to me, uh, keeping things simple, really, what does simple mean? Simple means don't waste time, energy, brain work, and especially capital. Well, easier said than done, but this market is so full of temptations. And the temptations, many of them come mostly from what we listen with, is our phones, what our friends say, etc. I'm going to show you a couple things today, really using the threes report, because I write it, fresh, a few hours before this meeting, and I try to make it more comprehensive every week without necessarily taking up a lot more words. Okay, so we're going to do that. I'm just calling it this sort of as a joke, my trading hack of the week. You learn a new phrase, and all of a sudden you become, you got to use it all the time. I want to talk about the bond ladder. I may just touch on it a little bit this week, but might devote an entire session to it because I think people are asking, and this is part of the simple. And then talk to you a little bit more about some of the stuff I'm doing educationally. And then this thing called Trade the Pool, which just interesting story. It was the best thing that came out of my trip to the money show because the power went out right before I was going to speak, and it worked out well and all that. But as I walked around the booths and stuff the next day before we drove home from Orlando, I found these folks, and it may not appeal to everybody, but I think it's I found a lot of very interesting platforms in fintech and things like that. So I'll walk through that. But let's start with the threes report. Okay, it won't end well, but enjoy it for now. And I've got a lot of floating headlines in my brain for what I'm going to write about. One of them may be I hear the death knell of stock selection, uh, because I think stock picking is getting a lot tougher to do, because so few stocks actually matter. By the way, I don't usually wear red for these. When I do, it's usually because I'm making a statement about something. What if you've been following the stock market? What would your best guess be as to why I'm wearing red, as in the color of losing money? Something happened today. There's actually two answers to this. Anybody want to guess? Why am I wearing red in sympathy? Okay, because there's a couple things that went down today. China Rising, good one, very contrarian. Nope, not that. Let me bring up the old bar chart here, and okay, good time to remind you we've got an affiliate code for bar chart. Very inexpensive to sign up, and I use a lot of this stuff. So there's a couple of things. Okay, so the market was up today. Oh, really? Well, the average stock in the S&P 500 was in the red to the tune of almost 1%. And this has been going on for quite a while now. I'm going to go back 6 months, and I'm going to shorten this up so you can really kind of see it. Okay, I guess that's going to go back a little bit more. Here we go. Okay. Here, a little bit more. Let's go back to, I'll just do the daily. Yeah, year to date. Okay. So other than this little bump at the beginning, RSP at the end of January, before we had a quick little collapse, was at 180. It's at 190. Okay, it's up. But you can't compare this to what's happening with the 20 largest stocks. And again, I'll shorten the picture up and just compare these two. The two charts I just showed you, similar time frame, they do not look a lot alike. They sure don't to me. Does it have a year date? It has a year date, yes. Okay. This run, the extent of this run in the top 20 stocks, I could extend to the top 50, almost to the top 100. Although curiously, I was doing some scratch stuff toward the end of the day here, and I looked at the S&P 100, the top 100 stocks, because I had a suspicion, always trying to figure out what's working, what's not working. So, and thank you, Dana. I see you put the link in there. We got a few affiliate links to help you guys save money if you want to use the stuff that we do here in the cockpit, as I like to say. So I went through the top 100 stocks by size. OEF is the ETF. And I wrote down, okay, which ones have, interesting positive chart patterns, which ones have interesting negative chart patterns. And let's see, I came up with 1, 2, 3, 4, so about 10 that look decent on the upside. Okay, daily charts, so fairly short time frame. I found about 15 on the downside, and the rest were not remarkable enough to say, okay, it's moving or it's not. I'm doing more trading than I used to, but to me, it's out of risk management entirely. I've written about this actually quite a bit. To me, trading in small size, and when I say trading, I mean I may hold something for a few days, I may hold it for several weeks, but it's not that long. Stocks, ETFs, a lot of option stuff. Okay. Um, this is a market where you kind of have to line up and redefine what is offense and what is defense. Offense right now is pretty much investing in the top. By the way, let me just see here. There we go. Good. I'll do it from here. Dan will tell me later why she changed the picture. I had a different picture in there. It was a falling over Christmas tree, because I was like, it's kind of early, but by Christmas, maybe some of the stuff will fall over. Anyhow, I can always go with Halloween. So we have an issue right now where so few stocks are driving the market. And, in my experience, the nature of this is it happens gradually, and then it just keeps going, and it gets to this point. You have days like today where, RSP, the average stock in the S&P 500. So in other words, okay, we saw that RSP was down 88 basis points today. That's the average stock. If you take the same stocks, but you weight them according to how big the company is, that's SPY versus RSP, you're more than 1% higher. And if this was like an anomaly of a day, I would say, okay, not even worth bringing up and wasting your time with it. But I think it's the opposite of that. This has just been happening so frequently. In fact, I'm curious, I didn't check it, but this is the top 1,000 stocks, EQAL. These are great market indicators, and it's also why I say all the time that people do not necessarily appreciate ETFs for how they are as research tools, and I'll show you that in a second too. Kind of skipping around the main points of the threes report, which hopefully you'll all read soon. Okay. Yeah, so the average stock here, I mean, this is the top 1,000. Not much going on for a long time with this. Okay. So, this to me, and if I went through a bunch of charts, and I'm happy to do that during these sessions, but I could zip through a bunch of charts and I would show you like winner, 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 winner at the top, and then loser, 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 loser. I don't mean for a day, I mean like for a while now. So it's a great stock market if you are simply owning the QQQ or some derivative of it. Okay. I'm going to have to go back and see, but this angle of ascent here, which is now taking off, okay, this is what I call building toward an Empire State Building top, okay? For those of you who, I'm sure everybody knows what it is, but generally what it looks like, okay? So, oops. Wow, imagine that. I try to get a picture of the Empire State Building and I get an advertisement. Okay. Don't be surprised. I have to get around the ad here. Okay. Don't be surprised if we see this. See what I'm mapping out here? Straight up and then straight down. This is what happened in the dot-com crisis. This is how it ended. It ended with the NASDAQ going up 75% in a matter of months. I think it was 4 months, might have been 3 months, 75%. I don't know if you get 75% again, but you get a lot higher than this. And before the same year was over, 2000, it had fallen from peak to trough by 75%. You're thinking, how can you even do that math? It went up 75%, might have been from later in 99, up 75%, and then down 75% from that level. I can certainly show you a picture of if you want to see. I think I've had it in some articles recently, and I think I had it in the threes report last week. So this is, look, I'm trying to set the scene for you here, okay? This is the state of the markets. So what do we need to do? We need to go back to the basics and basically say we have offense and we have defense. And I always have to ask myself, how am I playing offense and how am I playing defense? Generally speaking, there's some things that'll go in both columns here, but it is not, it does not have to be consistent. Okay. In other words, the ones you use at any point in time. So right now, if you want to make it really simple, and I'm going to also look at people say, okay, why? Well, SPY Bill, why is the Roar score still only at 20? It's been at 20 for the longest time. Well, first of all, 20% of a market that's going up like the needle in the Empire State Building, you're still making pretty good money. I do not care what the market. If I cared what the market was doing, then I'd be saying, all right, I want to take on if I'm up 40% or down 40% in a year, I'm okay. If you like that, SPY is a great investment because it probably has 40% up or down potential in a calendar year. If it's the NASDAQ, maybe a little more. So this is the basics of playing offense and defense at the same time. But if anybody's wondering, well, why is it only at 20? Well, because 20% in a market that is overvalued by every possible measure, and bound to fail epically and quickly. But I have no idea when. I don't even know what year. So this is what I call getting my fair share. And if I'm a conservative investor and the Roar score is at 20, well, that means that a conservative investor is going to have, if this is all you can do, SPY and Bill, 20% and 80% of their money in SPY and Bill. And part of it is Bill is still yielding almost 4%, 375, 380, okay? So literally, you're getting paid almost 1% every 3 months to do nothing and to give yourself time to wait it out. And look, I'm not saying go out and, fill your whole portfolio with T-bills, but if somebody said to me, Rob, I am going to take $100 and I am going to put $96 of that 100 into T-bills, and I'm going to put the other $4 into buying out of the money call options on triple Qs, okay? Well, guess what? You can't lose more than what you put up. And a year from now, this in the T-bills, it's called the Bill ETF, okay? Let's call this wild and crazy stuff. Remember, offense and defense at the same time. If you start with $100, you put 96 in this for a year. This is going to get you back almost to 100. Let's assume it's just over 4%. You get about 100 back. So you're getting 100 back, which means that your return for the year is going to be whatever you turn this into. You do wild and crazy stuff. I don't know what the TQQQ is this year, but let's see. I'm not even talking about options, all right? But let's see how the TQQQ is doing this year. Again, all hypothetical, but I'm trying to show you how I look at risk and reward. So let's see. All right. TQQQ started the year at 80. Okay, so it's up 50%. All right, so let's go back to here. If you turned $96 into $100 at the end, that's what we said, this is in T-bills, okay? 96, for those of you who speak the language, I think they call it beshert. It's meant to be, it's determined, it's predetermined, all right? So 96 becomes 100. The other 4, let's say we're up 50%. And I'm not talking about just buying and holding. I mean, whatever. It could be opposite. It could be, I'm saying, is that taking risk? Yes, it's taking risk, but it's taking risk with small amounts of money. So if the 4 becomes 6, you've just made a 6% return for the year and you took almost no risk. Okay. Your worst case scenario, all right, if 50% return would get you to 6%. If you lost all $4, you'd still make 4%. So you can imagine if you then go and say, all right, I'm going to put $20 out of 100 into this and 80 into bill. And now I'm going to try to, hey, by the end of the year, what's $80 going to be worth in T-bills? Let's call it 83 to be conservative. Okay. Well, that means that even if I lost 15% of this, okay, I start with $100, 20 in SPY or in something, 80 in something super conservative where you get your money back in a year. 80 becomes 83. If 20 drops to 17, that's a 15% decline, which means you had to be fairly aggressive, whatever you were doing. You've still broken even. That's 100. It's the same 100. So I wanted to give you that in part because whether you're listening to this live or you have questions you want to throw at me in the chat, if you watch this on recording, this is it. You want to talk simple? That's it. Okay. What everybody gets so focused on, hyper focused on, is what the picks are. Okay. I mean, every single day I have a bunch of stocks and ETFs. I say, it looks good, looks good. You know, it doesn't look good. Okay. But more and more, that's for like the near-term risk capital. Okay. In small size. The big swaths of capital, especially if you're anywhere in my age range, 61, so let's say at least 20 years either side of that, okay? You know, unless you're really just starting out, you know, in terms of making money. But this is one way to approach it. And really, when you think about it, okay, because I've been getting a lot of questions about this from different places. So if this is our current ROAR score, I want to show you there's a lot of ways to do this. Based on what I told you about where the markets are, I could use TQQQ for this if I wanted to. I'd probably just have to take something like this and I'd have to put in, I mean, look at what UVXY is, okay? It's like 1.5 times the change in the VIX. I actually have an account that only owns this and this. It's more of an experimental thing, but I wanted to see what would happen. And if you put these two in with each other, okay, and then put a slug of this thing in there too, but honestly, you don't even need it, okay? I mean, you could probably put 70, 80% of your money in here and maybe 10% in this. This thing will go up, just so you see what I'm talking about. We looked at TQQQ, UVXY. Okay. So we all remember what happened in April. UVXY, when the market was getting crushed, went from 19 to 53, just about a triple in days. You don't need options to do this. You just have to make sure that when you're using vehicles like VIX ETFs, that you position size it properly. In fact, I'm going to go back a few years on this. Yeah, I probably can't see it in there without spending a little more time, which I don't want to do. Okay, but if I can go back 3 years, okay, nope, too much. Okay. You can see this here though, all right? We had that little August kerfuffle with the Japanese yen and the carry trade and all that. Okay, what did UVXY do? It went from 21 and change to here again. So this thing has tripled in a matter of a week, twice in the last 14 months. Does that mean it's a buy and hold? No. Does it mean that you can get a lot of defensive points, if you will, out of this by pairing it with other things? There are tamer versions of it in terms of the inverse ETFs and the levered ETFs. But what I'm saying is it all comes down to offense and defense at the same time. There's a million different ways to get to what the equivalent of 20% in SPY and 80% in Bill would be. However, when you start to expand your use of ETFs to different types, potentially inverse, potentially leverage, knowing how to use them responsibly, same thing with options. You can take this and you can make the 20 only act like 20 when things are bad. When things are good, you might be able to make them it act like it's 30 or 40 or 50 raw score. Okay? That's how to use these modern tools that we have. And I mention this down here. Oops, I got the wrong one. Let me go back to, where's my email? Here we go. Okay. I'm showing you the draft, which we certainly don't need anymore. Yeah, you'll see it in here, but there's this whole issue of trying to keep it simpler, understanding fewer vehicles, if you will. And to me, this is how you combat some of the crazy times that we are going through right now. Because make no mistake about it, this is crazy. But there's no reason it shouldn't be crazy good for anybody who likes that. Let me see. Anything else from the? Just quickly see if there's anything on the charts. Okay, so that, this I walked you through. This is year to date for the average stock. These are the same stocks. Actually, not year to date. This is from the beginning of the AI. Well, what we'll eventually know is the AI bubble. Right now is the AI rally. Okay, the average stocks. This is going back to beginning of the fourth quarter 23. So that's a couple of years. I think I actually said 37 months in here. Yeah, 37 months. 2022. Fourth quarter of 22, all of 23, 24, and so far this year. So average S&P 500 stock up 58%. If you weight the same 500 stocks, you're up 100%. It's an even double. But all the action has been toward the top here. I don't see that changing because even when the top ones take a hit, I'm not seeing anything coming up to try to challenge it. All right. I'm a horse racing fan, and the announcer at Gulfstream, Pete Aiello, who is terrific. One of the things he will always say when the front runners in the race are just clear of the others, and it just doesn't look like anybody's going to be able to catch them. It gets to a certain point in a race where even if it's humans running, you're so far ahead they cannot catch you, even if you just slow down. And he always says, nobody coming up from the back or nobody running up from the back. And that's kind of what I see. They're not. I don't see all of a sudden that utilities or even energy stocks or consumer staples are going to make up for all this lost ground anytime soon. If they do, it'll probably be because they're down less, not because they're up more than the big caps. So more and more, the indexation of the markets, where everything's tied to an index, so they move up and down together, except for earnings and things like that. That's one aspect of this. The other is the algorithmic trading. Um, so markets don't operate the way we are used to them doing, and we have to stop making arguments for why such and such and such should happen because it's just like the old days. Okay, it's nothing like the old days. So the other thing I think is interesting to note here, when you look back about a year, okay, the average stock in this phenomenal stock market, right, is up about 5% in the past 12 months. Okay. Let me take you to those hacks that I talked about. This kind of goes back to what I was explaining to you here. Okay. Because what you're going to see me talking a lot more about coming soon is the idea that you can play offense and defense. Don't even worry about what the rules score is. Just talk concept. You can start with SPY and build, but you don't have to end there. You can say, all right, I don't even want SPY. I want the Qs, or I want the top 50 stocks, which kind of goes along with it. Oh, well, you know what? T-bills aren't quite the steal they were for the last couple of years. I'm going to look at Govy, which gives me access to the entire yield curve, 0 to 20 years. Or I'm so convinced that long-term bonds are going to do well, I'm going to just buy TLT. Or I am so convinced that it's all NASDAQ. Or, as you've seen me do, I'm just going to focus on the top 20 stocks. Okay? Some people may look at it and say, well, despite what's happened to gold, I mean, I think gold is toast for a while. I've been buying put options on it and rolling them almost every day the last few days because it's profitable. But that run in gold, I was very skeptical. But again, not taking big position sizes in it. So gold could be defense or gold could be offense, depending on how you think. Okay. You can even, you can look at Bitcoin if you're so inclined. You can look at things like, gee, I can't stand small caps. It's kind of what I just said a few minutes ago. All right. So it could be something like this. Or you could say, you know what? I really like those top 20 stocks. But for the rest of the S&P, I'm not so sure. Maybe I want to put that on the defense. So the whole idea here is you can pile up your favorite offense and defense. You could even put stocks in here. Oh, I want to own Amazon as part of my offense because I want to own it for a long, long time. And sometimes own a few percent of it, and sometimes own a little bit more, and sometimes own a little less. But I'm always going to own Amazon. Okay. There are even inverse ETFs on a lot of stocks right now. I can't remember a lot of the ticker symbols offhand, but I've got a whole list of them. And some of these quantum computing stocks, I've messed around with that a little bit. So again, define what is offense, what is defense, put your roster together. That's what we call a watch list. And then it's a matter of, okay, what percentages am I going to invest in each one of these at a time, which is another way of saying which ones am I even going to own at a time. Or you can simply say, because the results have been pretty good, I have to say, okay, I'm just going to stick to SPY and build, and I'm just going to tactically weight the two of them all the time. Because I've shown you the results. Happy to show you again. I'm sure I'll write about this pretty soon. But this dinky little, apply the Roar score to SPY and build, it's doing quite well. It's like a straight line 8% return in the middle of this market run. I think it's doing better than RSP at this point. So again, it doesn't have to be that complicated. I don't want anybody that is part of this club to ever think that, oh, well, we talked about so much, whatever. All I'm really talking about is offense and defense at the same time and rotating in between them. I use the Roar score, but understanding that the Roar score is nothing more than me. I mean, it's got some mechanics behind it, okay? And I can apply it to any security. But it's looking at this and saying, all right, after I've done some math on this, yeah, this could keep going. That's a breakout. That's a reinvigorated 20-day moving average right there in red that's moving up. Okay. Things been stiff as anything going this high since April. And that's okay. But I look around at things like this and I say, that's a very uncommitted chart to me. And there seems to be, if I look at Govy, the idea that, and let me pull this out a little bit more, okay, that is still tentative. It's got to get through here probably, but this is starting to look like rates could go down. This is bonds going up. What does the 10-year rate look like? Now we're looking at rates, not prices, okay? Well, the 10-year treasury was here at 481. It's down, snuck below 4%. You notice I haven't said a word yet about tariffs or the Fed. I don't care. I mean, I care to the point where I can make a case that I do exactly what I'm about to do here. Why do rates look like they're getting closer and closer and closer to dropping here? And I'm going to go back even further, like way further, saying, okay, now it looks like it's going to take a while, but you see I drew a little triangle here. It's getting close to breaking down through this, see, lower highs, higher lows. Sometimes it's called a triangle or a wedge, fancy technical term. All right. And this PPO indicator, which is clearly my favorite, it's just been kind of like saying, you'll have your rallies, but the trend is your friend, and the trend, your friend, is saying rates are going lower. Why might rates go lower? Well, maybe the Fed's going to do something tomorrow, but they don't affect 10-year rates. Why would rates go lower? My guess is recession, almost like a pop-up recession, because it's already hitting so much of the economy here. And tariffs and all that stuff is still a wild card. It's great to have announcements, but actual deals. And speaking of deals, I'm not sure about all this self-dealing. Again, I'm not a fundamental analyst, so other people can wax poetic about whether the idea that there's like 7 companies all just doing deals with each other, but then the critical person says, wait a minute, is it really just like double counting? Is there more value creation here, or is it just scratching each other's backs? I don't know. And again, I don't really care that much. I just care about what will go up and what will go down and what are my odds of it. And I look at all this and I say, the odds of the S&P 500 having a major up move versus a major down move, which will come first? I don't know, but I'd say probably about a 20% chance that 10-15% higher before 10 to 15% lower. And I'm thrilled to be wrong because I'm still going to have a piece here. And I can use call options and levered ETFs and a million other things to try to get more of that. And that is really the take home message from the threes report this week. I know I put a couple things in bold here. So here we go. Hey, I talk about single stocks. At this stage of the cycle, single stocks, will be at the whim of whatever the market does. Okay. So again, it's great if you can find some winning stock picks, but I would say, quote an old expression, dollars to donuts. Uh, there's a good chance that your winning stock picks are only going to be as good as the ability for the AI trade to stay afloat. There will be exceptions, but they won't last very long. And all you have to do, just a few that come to mind, this one, oops, this one finally recovered, not some obscure company mistyped ticker. Okay. Hey, big day for UPS. Okay. I bet all the I told you so's are coming out about UPS. Oh, yeah. Okay. You mean, I mean, I talk about Charlie Brown and Lucy and the football. Okay. How many of these have we had? I don't know if this is changing. Ask fundamental analysts. But what I'm telling you is, I see a lot of this. Great. UPS is up 8% today. It's up 20% nearly. Yeah, just about 20% in a very short amount of time. Terrific. It's almost like we don't even need the markers. Earnings, 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 earnings. I mean, I'm guessing. Okay. Always looks good on earnings, and then the sellers come. Why? Could be fundamental, but the idea is that there's so many other things that control us. I'll give you one more that comes to mind because I look at a lot of stock charts. Okay. Same thing, same thing, and looking worse. Uh, and then you'll have your moments like this one. Okay, everybody's going to lose weight on those drugs. Great, they work, they have side effects, etc. But honestly, like, where's this going? It's not going where. I would much rather look at it and say, I'll just take the market en masse. Lilly's one of the top 20 barely. Okay. I'd much rather say, you know what, I'm going to ride with this as a core position or something like it. I'm going to work around it with some other things that look good tactically, shorter periods of time, and I'm going to play really, really, really good defense by not just doing it with ETFs, but also looking at that bond ladder. So I think I have covered these two so far. It's not a good color for that. All right. We have knocked these out pretty much. Okay, let me go through these trading hacks very quickly. So read up on this. I also just wrote a Seeking Alpha article that came out today, and there's charts from it. And I think about, okay, if I want to earn some income, boy, this thing takes the TLT, writes covered call options on it. TLTW is a symbol. It's yielded between 14 and 18%, I think, since it's been out a few years ago. But it's got plenty of price risk because if TLT falls, this is going to fall too. You'll have a little bit of a cushion. Okay? TLT is 20 to 30-year bonds. So, I mean, there's some play there. But again, my sort of thesis is that I think rates are more likely to fall than rise. And that should lift the price of TLT. I might as well get as much income as I can, plus bonds have been so volatile, that also gets more yield. That's why this thing's still yielding double digits. But unlike the covered call aficionados, I look at it and I say, well, wait a minute. I'm not just doing that because while everybody should know, most people don't know that covered call ETFs have a fatal flaw. The market falls hard, and doesn't get up very quickly, you might as well just own it outright because you're going to lose a lot of money. And you can say, oh, but at least I got a dividend. And you're going to have to wait years for it to recover. So what I do is I say, well, I like TLTW, but unless I'm going to take a really, really small position that won't hurt me, I'm going to try to pair it with, it could be TBT, which is the double inverse of TLT, super liquid. TLT. TBT is also quite liquid. And when you put the two of them together, so it's like, let me get this straight. I've got 90, and it may not always be 90-10, but it's just like the Rohr score. It's another application of the Rohr score. So, I say, all right, I'm going to put 90% of my money in TLTW. I'm going to get 90% of my portfolio is going to yield 13, 14, maybe 15%. The other 10% is going to make it so that every time bonds get rocked and the price falls and yields go up, well, 10% of my portfolio is going to be double exposed to make money when bond prices go down. TLT goes down 10%, TBT ought to go up in the neighborhood of 20%. If it's a small part of my portfolio, that's going to offset some of the price damage from here. And so just to give a static example in the Seeking Alpha article and to show you here, this is just a flat mix of 90-10. I haven't even touched it. And yeah, over a 3-year period, 17%, great, it beats T-bills. But look at what happened to bonds, okay? This is including the income, the 4%, whatever, the TLT pays, okay? Look at this chaotic activity in this, and look at how this smooths it out, all while you're making double-digit yield, okay? When this was happening and TLT was falling hard in price, well, the other thing I can say is, just like with the Rohr score, if my typical balance was 90-10, maybe it would have been 80-20. And now I cut even more of that. I could probably even make money if I were daring enough. So what I'm saying is, I'm just using two ETFs here. In this case, two ETFs that by their nature go in opposite directions, except one of them piles on the income. To me, this is frankly the whole spat I've been having with some people in the comments section on the Seeking Alpha articles, because I talk about a covered call ETF and I say, they're okay if you want the income, but you're going to get crushed in principal. Take a look at the most popular one here. Okay, so this includes the income. I finally fixed my chart so that it doesn't. Okay, but okay, so this is now total return. That's a pretty steep drop. That's 15% right there, very quickly in April. Sharp comeback, but and if it hadn't come back quickly, it'd really be in the dumps. All right, but I mean, things kind of gone nowhere since the beginning of the year. If I'm going to get income, I don't want to give it all back in price. And there's ways to do that. And it's simply an application of the same SPY bill, except the offense is different, TLTW in this case, and the defense is different, TBT in this case. It's all the same concept, is the point I am trying to make. Okay, let me get to questions in a second. Let me give you the other one. There's a sneak peek of my next one. Okay, the other hack, and this is, be very quick with this because it's really about the, it's more of a trading thing, okay? What did I do? I went in, I literally did this at the end of the day yesterday, and again, my mind works, faster than average, I guess, because of all the years I've done this, but I'm trying to impart some of the high points, okay? Step one, see good chart, whatever that means. Anything you think you might want to buy. Then I do a screen and bar chart, which is super easy to do. I'll just show you quickly what it looks like. Stocks, earnings within 7 days, okay? And what I will then do is say, I want to get rid of all the market cap, the small market cap ones. Okay, I won't take the time to do it here, but I'll say, all right, let's set it at, I don't know, 50 or here. Okay, there's 2,700 stocks or something around the world with earnings in the next 7 days. So let's just say I only want to go up to, I don't know, what's number 100, okay? EQIX. So I'm going to write down EQIX. I'm going to click on this and look at this. Chart, 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 chart. Okay. Now, easy for me to say, okay, but you can come up with whatever process you want. But you see how quickly I could literally do this on, and maybe I put some of the screeners in, but you can do that. Okay, I don't want the big stocks. I don't want certain ones, whatever. All right. I've been going through just in a little trading account and saying, okay, let me see if I can make a go at this. Because part of risk management, again, is saying, oh, I'm going to have a lot of my money in a bond ladder, in treasuries, in collared equities, where there's a limit to how much money I can lose. And then over here, I don't need to use SPY. I could have a, you know, spec trading account with positions in small size. And again, it's whatever fits your personality. Okay. Now, what happened with Nucor as one example? It's not the only example, and I'm happy to share others if you guys don't think it's a waste of your time. I put stuff out there in the chat or whatever, and kind of tell you what I'm doing in there. And I've been talking about this for a few weeks, but I think the best way to do it is just kind of like, ask, or we'll come up with some, firm process for it. So chart was looking good enough anyway. Like, okay, fine. I don't know. I think I put like 200 and something dollars in this, whatever. Okay. But I did it, in this case, you do it with the stock. I did it with options because I was like, a couple $100. I'm willing to lose $200 if Nucor doesn't do well with earnings. Okay. Well, it was up 6% at the open, and my $200 went up to, I don't know, like 850 or something like that. It was 250 to 850. I sold almost all of it. I kept a little tiny piece of it left, and I think I still have it, because maybe this will go on for a while. That's the most speculative, sort of high. Again, I would say, is that high risk trade? I don't know. My worst case was going to lose $250. Okay, it's real money, but I would do a trade like that. And what was my upside? I don't know, probably 1,000, but I got most of it. They don't happen all the way, all the time like that, but that just gives you an idea of how that's just me taking another example of using the Roar score. Would I do this with half of my liquid assets? No blanking way. But when we're kind of have a dearth of opportunities here other than the same old stuff that's been working, I start to look for other things. And so I say, I'm going to have a shorter time frame for this stuff. I'm going to do it based on earnings pop drop kind of thing. I'm going to see if the charts look pretty good. In fact, a lot of the charts, as I mentioned, some of the charts look pretty good going into earnings. Don't even need to hold a full position when the earnings hit. Why take the risk? A lot of these things will start, moving up into earnings. Okay, I think Apple's coming up, right? A couple days, tomorrow. If it was today, I don't know. I doubt it. We would see. Okay, but Apple's been moving up in earnings, so this is how markets work now. It's just everybody's looking at this kind of stuff. Everybody's looking at charts. What they're not looking at, sadly, is what's the fundamental value of these companies, or the intrinsic value, based on the way Graham and Buffett and Munger did. They're not doing that. Okay. And so anyway, all right. So that's I'm going to do a special session on the ladder. All I'm going to do, I think we'll put that in as either a second session next week or otherwise. Okay. Now you should have recently something about me going through this. Okay. When we sent the thing out, I went through it. But the main thing I want to tell you about the ladder is that, again, it's as simple as, you pick your years, you decide how much money you want to have. I did an article on this for Bar Chart also. Look it up if you like. It was like taking 92. It was this exact example. I showed this table. Took $92,000 and exchanged it for a stream of $10,000 coming due every year for these 15 years. And so I'm turning $92,000 into 150. My hypothetical example was I start with $150,000. I was able to get 10,000 a year spun off for 15 years. Okay, doing some planning. In 5 years, I'll work hopefully a little less than I do now. I'll still be working for sure. Um, never stop doing this if I don't have to. All the way to when I'm 80 years old, and is 150,000 maturity value. But I said, hey, wait a minute. Okay, so that means that on my 150,000 is going to 92 of it's going to become 150 because I'm paying 58 cents on the dollar for these zero coupon treasuries that yield about 4%. Well, that's locked in unless rates go way down and these bond prices go way up and I decide to profit on the bonds instead. We'll deal with that if and when it comes. I've already sold some of them off in small pieces, made money on the bonds. But then the other thing is, okay, well, what else do you do? To me, this is almost like having a permanent ROAR score that's not 100. Because I'm saying, okay, I'm going to have a portion of my portfolio go ahead and get really, really sort of fixed return here at frankly some of the highest rates we've had in a long time. And so I'm locking in part of that and giving myself a second retirement income, if you will. Ladder's a little bit bigger than this, but you can do it even if you just want to experiment with it in small size. You can buy these things 1,000 at a time. $840 matures for 1,000. 640 matures for 1,000 here. Very easy to do, and if enough people want, I can kind of do a more detailed session on this. But all I'm telling you is, I think the bond ladder concept is just an absolutely gorgeous way to have a defensive stalwart if you're all concerned about what the markets will eventually do to your money when times aren't the way they are now. And it frees you up to be that much more wild and free on the offensive side with some of your money. So you can do something like this, or you can try something you wouldn't normally try, because some of your return is already locked in for a long period of time. All right, so we got through that. I'm going to take a couple questions, and then I'm going to close this up here. Okay, I would like to use UVXY as a 5% position in my defense column. What's your advice for making sure you don't miss the right time to cash in on a pop to get the insurance benefit? Well, it all has to do with the chart to me, but I will say this, just look at the history, right? I mean, when this thing, and let's do it by looking at the VIX, okay? Because this is based on the VIX. Generally speaking, the VIX likes to hang out between 10 and 20 most of the time. More recently, a little closer to 15, 18, okay? When it goes above 20, it's usually because the market's taken a little bit of a jolt to the downside. And if it gets up to 30, it's getting a little bit more panicky. But you see, sometimes, I mean, this literally lasted a day. When it gets into the, call it 25, 30 range, and it stays there for a little bit, okay, I would suggest take any type of charting program, or if somebody requests, I could probably do like a quick article, probably bar chart seeking alpha, and just show it to you guys and the rest of the audience through that. Okay, this goes in the opposite direction in the stock market, but with a lot more. It's almost like a levered version of it. So when you see the VIX get to 25, 30, that tells you the market's concerned. It's kind of on, on the edge of its seat. And then every once in a while, this can go. I mean, it doesn't happen that often. So again, this is why, like, I would rather own UVXY 9 times and lose a little bit of money each time just to be there for that 10th time when it goes bazoom. Because remember, with options, they're great, but once volatility goes up, no more option buying. It's too expensive. You don't get any bang for your buck. This is the longer term history, 30 years of the VIX, and you can see you've had nary a spike here. This is monthly, so this all happened within a month, really within a couple of days. Same thing here. You go back to here. You go back to even .com bubble, and people weren't watching the VIX the way they do now. You had a few pops above 30. Believe it or not, this was like an orderly 3-year sell-off. Okay, it wasn't the kind of stuff we see now. Why? Because markets have changed. You see, I mean, the highest level for the VIX in modern history was when we didn't think we were going to have a financial system anymore. But other than that, 2008, other than that, 45 was the spike. How many times did it get to 50? Well, look at this. 1, 2, 3, 4, 5. We had 5 spikes over 50 where there had only been one other one in modern history. So this might be as good an indication, kind of finishing where I started today, that the markets are different than they were. So what do you do with UVXY? I mean, it's hard for me to say, to anyone in particular, pick out your own, to try to give you a price point. If you have a 5% position in this, just know that it can lose a lot of money quickly. Okay, this most recent example, it lost 80% if you forgot that you owned it for 6 months, which would be the case here. Okay, I don't know, if you lost 80% of a 5% position, that's 4% of your total portfolio. If that's too much risk to take, don't take it. But I would never hold this thing for that long. When I hold this, every single day is live. Any day I could wake up, just like with the Nucor. Okay, I mean, it's a microcosm. But when you have a position that is that volatile, like call options on Nucor, all right, then I look in the morning. Oh, look at this, $250 now, $850. Sell. I don't care if I'm walking in to get coffee or making my breakfast or sitting in front of my screen. That is going. Okay, but again, that's me. All right, done this my whole life. So in your case, know that if something sudden happens, okay, and again, it's never a matter of buying or selling the whole thing. When you have something like this, you can position size it. You can make it say, okay, if I get that pop I really wanted because the market's getting crushed and everybody's freaking out temporarily, looked like we had one here and then it was another false alarm, like it usually is, then, oh, okay, great. I took 5% position, very aggressive. I made pretty good money on it. Maybe it doubled, whatever. Well, let me shrink it back to 5% or 4% or 3%. I'm just giving you some narrative around different ways you can do it. Everything, just like the Roar score, okay, this may be 2080, but if I'm looking at the markets daily, I'm constantly figuring out how 20 and how 80 am I, okay? So hopefully that helps out. Okay, who is buying to raise the price with earnings, retail or algorithms? Hard to say, but I would guess is a combination, but favor the algorithms, and the hedge funds, and especially with the big stocks, just money goes in indexes, and they're not buying the little ones; they're buying the big ones. Think about it. There's a lot more S&P indexing than there is small cap indexing. That's why for now, small cap indexing is kind of done. Or I should say small cap investing. Let's see. Did you buy weekly options on earnings out of the money? Out of the money, yes. I mean, I think in this case, I only went out a few days, but I would go out, let's say, a few days to a few weeks with the options. But again, I'm thinking more in terms of I start with how much can I lose if this totally screws up? And if I'm good with losing 100% of it, I will go ahead and do it. You don't do this to say, if I'm down a little bit, it's like having a stop order on Enron, and it goes to zero. Well, if your stop order was here and in a matter of days it's down to here, you're not going to get your stop order out. Okay. Great. Yep. Extra planning session on bond ladder. Yep. Okay. Good. I think we have all the questions from the chat. I'm going to break here for the week, but I mean for this session, but use the chat. Use it a lot, and with the idea that we're going to be doing a ladder session, maybe we'll shoot for 2 next week, as long as we can schedule it. All right. I'll send
Rob, can you
something
take a
about this
verbal
in the
question?
chat. It's very, very interesting. Okay.
Rob, would you take a verbal question?
Quickly, yes.
On your article that you posted on the TLTW and TBT pairing, you talk about rebalancing maybe back to the 90-10 monthly, but you also talk about tactically adjusting TBT based on market conditions. What are those market conditions? What would you be looking at to know how to size the TBT portion?
It is it's too long an answer.
Okay.
But the bottom line is I'm not looking at TBT. I'm really looking at TLT because everything else is just a derivative, if you will,
Sure.
of that. Okay.
Sure.
So, snapshot is doing well. It doesn't look like it's about to burst higher. It probably looked a little bit better with a PPO down here or here. So it still looks okay. But you have to start with how much of each do I want to have and ranges. In fact, that will be, I'm going to make a note on that because I think that these kind of special sessions about a particular aspect of risk management and offense defense at the same time can be more effective than me reviewing the markets for more than 2 minutes every week.
Yeah,
So
you definitely need more. The concept is clear on the pairing, and it's a very nice concept. I've been thinking about something similar myself. But the problem is that for us to execute it on our own, we need a little more guidance because what you're basically saying is, well, I'll decide what to do with TBT tactically by looking at the chart.
Hold that thought because that is the focus of the entirety of my educational content. Thanks to a good friend of mine who's been helping me convert this stuff from Sun Garden Isbit's language into language called English. Okay. All right. Thank you all. See you in the chat, and we'll start setting up this little mini series of focus sessions on this. Okay. So thank you, Ron. Thank you everybody for the questions, and we'll see you soon.
Take care.